Happy election day. On this election day, we're seeing a total bunch of things. We're seeing crypto blowups. We're seeing market rallies and market dips intraday. It's a whole lot going on. So let's break it down. Let's talk about what we're looking at, and let's focus on ultimately what's important. First, we're going to start with the elections because it seems to be what everyone wants to talk about and what's driving markets. People are thinking Republican win, market rally, short-term market rally, maybe long-term market rally. The market has historically done well with a Democrat president and a totally Republican-controlled Congress. However, that might factor in good economic environments. Right now, I would not say we're in an ideal economic environment, and that there are bigger forces at play rather than who the talking heads are in politics. It's as simple as that. Right now, there's some serious, hardcore forces taking place, and we're going to get into that, and I think that has part to do with the crypto blow-up today, FTX, all the coins down, this liquidity crunch. What is the bigger force at play here? Well, it's real big, it's real macro, and it's the opposite of money printing. For the last definitely 2 years, but arguably the last 10 years, the Federal Reserve has been churning out dollars and dollars and dollars, recovering from the last liquidity type situation, catastrophe, in order to avoid a more terrible type of situation. However, we've got to a point now where we need to suck up all these dollars. All these dollars is called excess liquidity, needs to be sucked up. Interest rates were low, more money was free, people needed to deploy money because that was a better use of money. And there were areas of the market and the global economy that experienced excesses. One of those areas is crypto. It was the perfect breeding ground for something like this. And now as we're starting to get deeper and deeper, whether we still are closer to the beginning or whether we are actually closer to the end, unknown. Regardless, we are getting deeper and deeper into this tightening cycle, which has been going on for less than a year and has only really in the past couple months started to, well, I guess past few months, because a couple means two, past few months has only started to really get a little serious. Only really started to get a little serious. It's still not even serious. Only now are we starting to see signs of some blow-ups, actual blow-ups, not just asset values coming down. We're talking total removal of excesses which should not exist. This is one. We've talked about the past ones. I mean, we basically just assumed this was going to happen at some point. It's happening now. Sorry, 20% on the phone. It's happening now, likely going to happen again when companies that are pre-revenue, pre-earnings, unprofitable, shouldn't be public, but have gone public, begin to have issues raising capital because they raised capital, they went public, they SPAC'd, whatever it is, in an environment with excess liquidity, low rates, and a need to deploy capital. Now, rates are going up. Tomorrow, you're going to get a better interest rate than you are today. There's going to be less dollars tomorrow than there are today. And the excesses are the first ones to get hit. That's just the way it is. Do you see the picture? When money is plentiful and too much, there's excesses because it needs to go somewhere, right? It's losing value, inflation, interest rates are low. Nobody wants to hold it. They want to put it in things. That is the breeding ground for excesses. Now the money's getting pulled back, it's getting vacuumed rather than printed. The excesses are the first areas people start to really take it out of, and there just becomes a mega imbalance, and explosions begin to happen. We're seeing explosions begin today. We're going to continue to see them in these SPAC type, over speculative, pre-revenue, pre-profit companies. And there's going to be a wave of bankruptcies. We've talked about this coming wave of bankruptcies before on this channel. And it's going to happen. It's going to happen. This is what it's going to look like. It's going to be very chaotic, very strange, and it's going to happen so quickly, almost out of nowhere. The company's going to run out of money. They're going to do whatever they can to make payroll. They're not gonna. And then they're going to declare bankruptcy. And I don't know how deep it's going to get. It could just be crypto. It could just be SPACs. But in 07, 08, we saw it get all the way to some of the most biggest, prominent, and historical investment banks in the world. So it's hard to say how deep it's going to get. Money is leaving the system. Everything is being forced to be allocated where it should be allocated. And we all know that was a very strange environment we are coming out of. We were just in COVID, etc. So we want to avoid areas that might explode and blow up and that are susceptible to this. We want to be invested in good balance sheets, delivering phenomenal cash flow, and have no default risk. ExxonMobil, printing money, like Apple kind of money, except its valuation is rather cheap. Rock solid company that is experiencing fundamental macroeconomic tailwinds and is not susceptible to these liquidity pulls and the decrease in money supply. If we can stay in these companies and we can have some cash and we can still take a few small other speculative bets that we think can survive through this very difficult period of liquidity crunch and quantitative tightening, because that's what's happening and isn't just something that can do well in a quantitative easing period, but is actually strong enough fundamentally to weather whatever's going on, you can take that bet. And then some shorts, of course. That's our current makeup. So it's not completely dead. This is not a panic and run situation. What I'm trying to say is we were in a very stimulative environment. We're now entering a quantitative tightening environment. We went from quantitative easing, quantitative tightening. You know that. What we saw today is the surface of what can happen. How deep we're going to get, very difficult to say. I don't think it's going to get to BTU. I don't think it's going to get to Exxon. These companies are way down at the totem pole of blowups. They're not going to blow up in the same fashion these companies did. FTX, Binance, kind of doing this shady deal that's non-committal just to get people to calm down in the market. I mean, this is crazy. That's surface level 1. Surface level 2, which I think we will get to, and we will exploit. It'll happen. It'll be cleaned out. Will be bubblicious stocks. A lot of those are going to go away. They raised cash. They have that cash on the balance sheet, but because they aren't profitable, they have to drain the cash every day. Less cash in the bank. The cash balances go down. At some point, they're going to say, oh, we need to raise money again. Guess what? Because the excesses are getting drained, they're not going to be able to get not going to be able to raise new capital to get cash to pay the bills, and are going to have to file for bankruptcy. Just like how FTX was able to shake up the crypto markets today, once we pierce that veil into the SPACs, we're going to see a lot of speculative companies, SPAC type companies. Those are going to have some ripple effects, and hopefully it stops there. But it could continue to go into other non-profitable companies. If your company is generating earnings, generating profits, doesn't need to borrow money in a higher interest rate environment, it's probably okay. It might take a valuation hit because interest rates are going to go up. That's just the way of it. You want to pick something that is trading at a very good multiple that has economic tailwinds and can somehow grow earnings right now. Look at the oil companies. They're growing earnings. Coal companies, they're growing earnings. Refiners, oil refiners, gasoline refiners, diesel refiners, they're growing earnings. These are good companies. They're growing earnings. You don't have anything to worry about except interest rates. But they're growing earnings. They might grow them faster than interest rates. You get the idea. We'll see what happens. Today provides us with some insights, reminds us that there are issues like this in the market. We'll see what happens. We'll see what happens with the election. We'll talk tomorrow. And until then, peace out.